The darker view is that the excess manipulation of money blows up the entire system. And that's a lot of people hold that view, that you end up with a hyperinflation or something of that sort, a total economic collapse. But I struggle to get to that answer because in every circumstance, when asset prices collapse or something goes wrong, they just print money. And when you're the world's reserve currency, it's bloody difficult to hyperinflate it. So what you end up with is this ridiculous rise in asset prices, which then gets rid of this ability to have this massive downside. So I think we've taken the big downside away. Well, we've traded it off for something else, which is everybody's incomes basically get poorer in purchasing power over time versus assets.
There is a looming possibility of a comprehensive financial collapse, potentially surpassing the severity of the 2008 crisis. The primary catalyst for this ominous scenario is the relentless practice of money printing by central banks. This incessant printing poses a significant threat to the entire financial system. Governments and central banks worldwide find themselves in a precarious situation, having metaphorically painted themselves into a corner through excessive printing of currency and accumulation of substantial debt. With the accumulation of dollars and the mounting debt, they are now compelled to print even more money merely to meet the interest obligations on their existing debt. This has initiated a perilous spiral that has spiraled out of control. According to macroeconomic expert Raoul, this precarious situation has the potential to detonate the entire system. In his recent interview, he delves into his worst-case scenario, outlining how he envisions this crisis unfolding. Powell proposes a solution to this impending catastrophe: the establishment of a parallel financial system that addresses the shortcomings of the traditional financial framework. He suggests that cryptocurrencies, with their decentralized nature, could provide a viable alternative to mitigate the issues plaguing the existing financial infrastructure. DailyDoseCrypto Challenge. Win $1,000 of Bitcoin. Simply subscribe to our channel, like this video, comment below how much you think Bitcoin price will be on January 1st, 2024. Winner will be announced January 1st, 2024, 6 p.m. GMT time. Good luck.
2008, every major government in the world of a developed economy hit 100% of GDP in debt. So, okay, and interest rates, let's say 5-year interest rates where they generally finance themselves, have averaged around 2% or less. But so is economic growth. So if you think of GDP as all of the money circulating around to pay for the debt, there's no more money left over. But the problem is, the private sector is over 100% of GDP in debt in every major country. So who pays for that debt? So that's when they started shoving the interest payment debt onto the balance sheets, because the world basically hit the tipping point in 2008, and people still haven't worked this out. But I think I was the first person, and still maybe the only person, who's gone back and calculated all of the interest payments and realized that they are, and the balance sheet growth, and realized that they are just 3.5 years apart. It's the same chart. They just keep monetizing it. And that's the way that they see out of the debt, is to mutualize those payments across everybody by increasing the balance sheet. But the debt doesn't go away because GDP is not growing fast enough. So you have to change the GDP formula. If not, you're in this endless trap where you're printing more and more money, making the rich richer, the poor poorer, ad infinitum. And I think that for individuals, as I said, there's only 2 assets that outperform this. That's technology and that's crypto. Okay, fine. The economy, that's really hard to get this to sort itself out. People are waiting for a collapse and markets down 80%. It can't. The reason it can't is the central bank debased the currency and it makes the stock market go up optically, because they can't allow the collateral of the system to go bust. So they don't allow the system to go bust, and it creates this ongoing problem. But if you listen to the narratives from the central banks and the governments, what they're really saying is the whole green energy revolution. Europe is massively funding this. And yes, it's good for the planet. Yes, it's good for a number of things. But really what they're trying to do is lower the cost of electricity. Because if you lower the cost of electricity, it has this multiplier effect on productivity. And that's how you can grow GDP growth. The other thing is population. Well, we're shrinking populations, as I said, so we have to replace people. So look at Amazon warehouses. The growth is not in people, the growth is in the robots. The robots work 24/7, 365, they never complain, and they cost a fraction of a human. So every company is incentivized to employ robots to do jobs instead of humans. Then this year we had the nuclear bomb of deflation, which is human knowledge, lawyers, doctors, accountants, creative artists, developers, everybody, and they're replaceable via the infinite knowledge machine that is AI. So that's scary for us as individuals. But if population growth is a large part of the components of GDP growth, you can create infinite people by the robots and AI. So there are schools of thought, even coming out of Oxford University, that says we could hit a tipping point where the GDP of the planet doubles in a year or even a week. Now that sounds extreme, but if you put infinite people or infinite productive units into the economy, you can make infinite goods. Now who pays for the goods? Maybe the machines pay for the goods. We don't know. This is a whole new economic system being built in front of our eyes. This is something I call the exponential age, which is where all of these technologies are coming together, from energy to AI, to robotics, to EV, to space, to 5G, 6G, all of these things, biotech, all coming together, genetic sciences, to create this fastest period of technological change in all of humanity. And it's the only way out, and it's scary. When I discovered this whole understanding, both the exponential age and the everything code that came later, it was like a veil had been lifted from my eyes. Macro guys generally tended to be mean reversion guys. They look for something to get excessive, then they want to, bet against it. And they see the world like this, like the business cycle. And none of us could understand technology and why it kept going up. We kind of could understand crypto because it's like this macro phenomena of, a whole different financial system, parallel financial system, getting adoption, etc. But technology, none of us got, apart from the few. And when I started dividing everything by the central bank balance sheets to take account of debasement, I saw that technology was one of the things that just kept rising. And that led me to dig into this whole process. And that completely changed my framework of the world. I wasn't looking for the blow up now. I was looking for the melt up. And, crypto markets had taught me to use these logarithmic charts of these trends. If you look at the chart of Amazon, Apple, Google, Facebook, all of these, on a logarithmic chart, they're almost perfectly smooth trends. They're network adoption models. But when you look at them normally, they look like they go up and down a lot. Yes, they do, but within a consistent, secular, powerful trend. Once I saw that, I'm like, if our job is to make money, then this is the trend you need to be on, the secular trend, because it's driven by the central banks. It's driven by technology itself, but then also driven by the central banks debasing. So you get the double whammy from it. It's like, okay, this is perfect. And it also is the answer to the massive macro problem of excess debt and slow GDP and aging populations. So when you've got something that's so against the persistent narrative that everything's screwed and it's all going to go wrong, and you see it and do a lot of hundreds of hours of research on it, and you come up with a completely opposite view, it's like, oh my God. And then I started surfacing that view for Global Macro Investor, and then within Real Vision and elsewhere, and it was like a light bulb moment for people. They're like, oh my God, I suddenly now understand why things are happening as they are, why technology stocks keep outperforming, why crypto keeps going up, why people are angry, why politics have become so polarized. It all starts to make sense. And if we can make money from it, great. The darker view is that the excess manipulation of money blows up the entire system. And that's a lot of people hold that view, that you end up with a hyperinflation or something of that sort, a total economic collapse. But I struggle to get to that answer, because in every circumstance, when asset prices collapse or something goes wrong, they just print money. And when you're the world's reserve currency, it's bloody difficult to hyperinflate it. So what you end up with is this ridiculous rise in asset prices, which then gets rid of this ability to have this massive downside. So I think we've taken the big downside away. Well, we've traded it off for something else, which is everybody's incomes basically get poorer in purchasing power over time versus assets. But I don't see... Okay, the other downside people would say, and there's validity to it as well, is that the excess use of monetary policy creates sticky inflation, and that therefore interest rates need to be higher. But I've lived through whole periods of higher interest rates and asset prices still go up. It's just the rate of change at interest rates that matter. You know, markets don't like rates going from 0 to 5.5% in record time. But even if rates stay at 5% for the next 10 years, it's not going to stop people buying technology stocks. Why? Because their ROI is much higher than 5%, so nobody cares. And most of those technology stocks don't have debt, so they have cash. And their cash on their balance sheet is going up at 5.5% a year because they're putting it into bonds. So it's this compounding effect for these companies that is so powerful, it's difficult to change. This is the fourth turning. We're building an entirely new system. We're building an entirely new structure of the economy. And the fourth turning was never going to be what people wanted. It's what happened. You know, a lot of people think of the fourth turning and they want to go back to the 1950s, and other people want some other variation of it. But what's happening is in front of our eyes. We're building an entire parallel financial system at record speed in front of us, built on top of the internet. And then we've just built this knowledge monster on top, this new kind of god. So within this is a new system. How that works, I have no idea yet. I can see the crypto side, that's pretty straightforward. How the rest of it works, this is the fourth turning, and this is the answer for the other side of it. And like all fourth turnings, it's going to create an enormous amount of friction, fear, misunderstanding, but eventually optimism.
Raoul discusses the looming possibility of a severe financial collapse, a scenario even more formidable than the 2008 crisis. The gravity of the situation is evident, with stakes reaching remarkably high levels. The relentless money printing by central banks has precipitated a precarious state where the very foundations of our financial system are now at risk, as eloquently detailed by Raoul. However, amidst these challenges, Raoul introduces a ray of hope. He envisions the emergence of a parallel financial system rooted in cryptocurrency, offering an innovative solution that could serve as a way out of the descending spiral. This approach provides a chance to rebuild on more stable and sustainable foundations, presenting a potential remedy to the imminent threats facing the financial landscape. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.